A beginner's guide to investing in stocks. Investing in stocks can seem like a daunting task, especially for beginners. The world of stock markets is filled with jargon, fluctuating numbers, and complex charts that can easily overwhelm someone who is new to it. However, investing in stocks is also one of the most effective ways to grow your wealth over time. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. What is a stock? A stock represents ownership in a company. When you buy a stock, you purchase a small piece of that company, known as a share. As a shareholder, you own a portion of the company's assets and earnings. The more shares you own, the greater your ownership stake in the company. How stocks work. Companies issue stocks to raise money for various business activities, such as expansion, research and development, or paying off debt. In return for your investment, you are entitled to a share of the company's profits, which can come in the form of dividends or an increase in the stock's price. Stock prices fluctuate based on a variety of factors, including the company's performance, investor sentiment, and broader economic conditions. When a company performs well, its stock price typically rises, leading to capital gains for shareholders. Conversely, if a company underperforms, its stock price may fall, leading to potential losses. The basics of the stock market. What is the stock market? The stock market is a marketplace where stocks and other securities are bought and sold. It provides a platform for companies to raise capital and for investors to purchase ownership in those companies. The stock market is a crucial component of a free market economy, as it allows businesses to grow and investors to build wealth. The stock market consists of primary and secondary markets. In the primary market, companies issue new stocks through an initial public offering, IPO. In the secondary market, investors buy and sell stocks that have already been issued. Most stock trading takes place in the secondary market. Stock exchanges. Stock exchanges are platforms where stocks are traded. The two most well-known stock exchanges in the United States are the New York Stock Exchange, NYSE, and the Nasdaq. The NYSE is home to many large, established companies, while the Nasdaq is known for its technology-focused companies. Other major stock exchanges worldwide include the London Stock Exchange, LSE, Tokyo Stock Exchange, TSE, and the Shanghai Stock Exchange, SSE. Types of stocks. Common stocks. Common stocks represent the majority of stocks that investors buy. When you own common stock, you have voting rights at the company's shareholder meetings and are entitled to dividends if the company decides to distribute them. However, in the event of a company's liquidation, common shareholders are last in line to receive any remaining assets, after bondholders and preferred shareholders. Preferred stocks. Preferred stocks are a type of equity that typically offers fixed dividends, meaning shareholders receive regular, set payments. Preferred stockholders have a higher claim on assets than common stockholders in case of liquidation. However, preferred stocks usually do not come with voting rights. Growth stocks. Companies with growth stocks are expected to grow at an above-average rate compared to other companies. These stocks typically do not pay dividends. As the companies reinvest their earnings into expansion, growth stocks can be riskier, but they also offer the potential for significant capital appreciation. Value stocks. Value stocks are those that appear to be undervalued compared to their fundamentals, such as earnings, dividends, or book value. Investors in value stocks expect the market to eventually recognize the company's true worth, leading to a price increase. Dividend stocks. Dividend stocks are those that regularly pay dividends to shareholders. These are typically established companies with stable earnings. Dividend stocks can provide a steady income stream, making them attractive to investors seeking income in addition to potential capital gains. Why invest in stocks? The power of compounding. One of the primary reasons to invest in stocks is the power of compounding. Compounding occurs when your investment earnings generate additional earnings over time. For example, if you reinvest the dividends you receive from a stock, those dividends can earn dividends themselves, leading to exponential growth of your investment. The longer you stay invested, the more powerful the compounding effect becomes. This is why it's often said that time in the market is more important than timing the market. Getting started, how to begin investing, setting financial goals. Before you start investing, it's important to define your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Your goals will determine your investment strategy, including the types of stocks you buy and your time horizon. Risk tolerance and time horizon. Understanding your risk tolerance is crucial when investing in stocks. Risk tolerance refers to your ability and willingness to endure fluctuations in the value of your investments. If you have a low risk tolerance, you might prefer safer, more stable investments. Conversely, if you have a higher risk tolerance, you may be comfortable with more volatile investments that offer higher potential returns. Your time horizon, or the length of time you plan to hold your investments, also plays a significant role. If you have a long time horizon, you may be able to withstand short-term market volatility in pursuit of long-term gains. On the other hand, if your time horizon is short, you may prefer more conservative investments. Building an emergency fund. Before investing in stocks, it's essential to have an emergency fund. An emergency fund is a savings account with enough money to cover 3 to 6 months of living expenses. This fund provides a financial safety net in case of unexpected expenses, such as medical emergencies or job loss, and prevents you from having to sell your investments prematurely. Common mistakes to avoid: chasing hot stocks. One of the most common mistakes beginners make is chasing hot stocks that have recently experienced significant price increases. While it can be tempting to jump on the bandwagon, buying into a stock after it has already soared in value can be risky. The stock's price may have already peaked, and you could end up buying high and selling low. Timing the market. Timing the market involves trying to predict when stock prices will rise or fall and making investment decisions based on these predictions. However, market timing is extremely difficult, even for experienced investors. Trying to time the market can lead to missed opportunities and poor investment returns. Investing in stocks can be an effective way to build wealth over time, but it requires knowledge, discipline, and a long-term perspective. By understanding the basics of stocks and the stock market, setting clear financial goals, choosing the right investment strategy, and avoiding common mistakes, you can increase your chances of success. Remember, investing is a journey, and there's always more to learn. Stay curious, keep educating yourself, and don't be afraid to seek advice when needed. With patience and perseverance, you can achieve your financial goals and secure your financial future through smart investing in stocks. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.